Very good afternoon from London. Welcome to the RANsquawk Weekly Wrap. Has been a very busy last few days in the financial markets. Just going to answer some of the few questions we've had through to the desk this week. So the ECB Governing Council taking the unanimous decision to cut rates by 25 basis points at Mario Draghi's inaugural presidential meeting. Taking a look at the rationale behind why they've done this, the recessionary pressures are now affecting the Eurozone core countries as well as the periphery. Taking the notes of the ECB chief economist Jürgen Stark on the wires today, he foresaw fourth quarter growth in the euro area as either flat or now in negative. That's allied earlier in the month with comments from one of the German economic forecasters forecasting first half growth for next year in Germany to be near recessionary. So we have had that coupled with some startlingly weak factory orders out of Germany today. So therefore moving forward, there has been a case in point in Italy. The 10-year government bond yield spreads in Italy again today hitting fresh highs of record for the euro area for Italy. That's also been allied with the political pressure there, but we have seen the ECB's non-standard measures such as the securities market programme active in the Italian curve, and with that having a negligible effect, the ECB has therefore had to rely on its primary weapon, the cutting of interest rates. With the banking sector then possibly looking to be at the forefront of any economic recovery, there has been a slight easing in the interbank tensions. We've seen the Euribor 3-month fix today fix lower by around 100 basis points compared to the previous reading before the rate cut. So this may help tensions slightly ease in the interbank market, but however, nevertheless, market tensions do remain high, with the Bunds today hitting another point gain and the equity markets coming under some selling pressure. So it remains to be seen how the ECB will go forward with any further measures, particularly in terms of the LTROs and liquidity provisions. So it'll be an interesting time going forward then in the Eurozone. Greece, the sick man of Europe, cannot stay out of the headlines. Today we have the confidence vote scheduled for around 10 o'clock London time after the market close. Just taking a closer look at what to expect, we have source comments that the Greek PM Papandreou may actually in fact resign even if he does pass the confidence vote. This is in order to form a coalition with the main opposition parties who have source comments have noted have already agreed to back the bailout agreement already agreed on October the 26th. So with that in place, there will be a caretaker government in order to receive the next aid tranche. Greece has enough cash, according to sources from the finance ministry, to last up until mid-December. And taking then a look at the caretaker government, they will have around 3 to 4 months to call snap elections, and following that there will be a government of national unity which will have no solid majority. It will be made up of every party or majority party in parliament, so it will be therefore very hard for any laws to be passed in Greece, making a tough situation even tougher. What we do know is that no referendum now has been scheduled, so that has provided some relief to the markets, but given that the confidence vote is very uncertain with Greek PM Papandreou's PASOK party no longer having a majority in parliament, but the most likely scenario then is the one outlined. There will be a coalition government for the next 3 to 4 months before snap elections will be called for a unity government. But in the meantime, do not expect any easy ride for Greece in the future going forward. Thank you very much for listening to this video. We do enjoy doing these weekly wraps for you, and I hope you have a great weekend, and I hope to see you then next week.